Perfect. Well, good afternoon, everyone. My name's Eric Bibel with the Bible team at Neo Home Loans. I'm joined with my business partner, Nate Bratlin, and we were all gathered here today on behalf of a collaboration with J&J Realty. This is part one of a multi-part series, really disseminating information down all real estate and finance related. And really today, part of this series we wanted to kick off as to, are we in a bubble? What's going on? Really, what's been happening as of recent, specifically within the real estate market, is eerily starting to feel a lot like what just happened in 2008. Massive run up in prices, correction in interest rates, inflation out of control, and it's got a lot of people thinking are we nearing the top and going to see a pretty significant correction within the housing market? And the short answer to that question is no. And here we've really articulated out a tremendous amount of vital information to really address that question head on and give empirical data to really support the insight thought around that we are not in a bubble, and really what we're experiencing is a reflection of market demand. So here we'll start off with something that we built out. And again, everyone will have access to a copy of this recording as well as the slide deck. And obviously any questions, we're all here to support. There will be some time after the presentation for open question and answers. So please, anything that comes up, put it in the chat and Nate will make sure that we get those questions answered. So first and foremost, 2022 started off as quite the roaring year. We've got really three kind of unique components that are happening. One being inflation. It's commanding news cycles from the cost of gasoline down to any and all consumer goods. We're paying it both at the pump, grocery stores, restaurants, the list goes on and on. We've seen the inflation continue to be a significant driver of the economic cycle and in turn, mortgage interest rates. Second, Fed rate hikes as well as balance sheet runoff. Really the main combatant to challenge inflation in previous cycles has been with the Federal Reserve adjusting their stance within the monetary policy. And really the quickest way to combat inflation is through incremental rate hikes. Second is balance sheet runoff throughout COVID. And really in cycles past, way to stimulate the economy, the Fed has stepped in to purchase types of investments. Well, now they have sunsetted that aspect and we're starting to see balance sheet runoff, which is also having impact of why we've seen interest rates run up as fast as they have. And third, the most kind of compelling thing is the recession talk. Are we heading into a recession? Really wanting to talk through that and what that means for housing, as well as what that means just around the horn. So we'll start off here, a little history around the Federal Reserve and really kind of similar patterns that we're experiencing in the current context. Going back into the mid 70s, early 80s under the control of Burns and Volcker. It started off in the 70s, inflation went from 7% to 14%. At that point, there were gas shortages, gas lines. I mean, you name it, it was really, really felt at the consumer level. Mortgage interest rates went from 12% to 18%. As a response to combat inflation, Burns and Volcker both stepped in and adjusted the monetary policy, raised the benchmark rate. We saw it raise from 11% to 20%. What was the response from inflation? Well, inflation came down in a pretty significant way from 14% to 5%. Secondary component to that, as the response from the Fed kicked in, we saw mortgage interest rates drop from 18% to 12%. Within that, the S&P, the Dow, really the markets or equity sectors, we saw a sharp sell-off, down 30%. What happened thereafter? Recession. Fast forward, Alan Greenspan, inflation goes 1.75% to 3.5%. Mortgage interest rates follow 7% to 8.5%. They step in, start to combat inflation, raising the monetary funds rate, goes from 4.75, 6.5. What happens to inflation? Tapers back, pulls down to 1%. Mortgage interest rates again, simultaneously respond. We see them move from 8.5% to 5.5%. Secession thereafter, S&P falls 50%, followed by recession. Fast forward to today, Jerome Powell, current chairman for the Federal Reserve, inflation at the beginning of 2022, or really 2021, it started. Inflation goes from 1.5% to its current state, just under 8.5. Fed funds rate to start of 2022, as of now, 0% to 3%. What's happening? Well, PCE numbers just came out today, which is the leading indicator of inflation. We're still in the thick of it. So here it's a little too early to tell if their efforts have dampened or tapered inflation. But the news that came out today, so just hot off the press, the 27th of May, we saw inflation did not move. So it might be a little too early to tell, but we've seen a pretty sharp response to the Fed's stance within combating inflation. Mortgage interest rates are up. We've gone from 2.5% at the tail end of 2021 to now, as of today, we're sitting right around 5.5%. So again, as this unfolds, we should see a response for mortgage interest rates going forward. Stocks, we all know what happened over the last few weeks. Stock market's in its 7th week of decline. What's happening? Are we heading into a recession? Looking at history as our best form of context, very likely that will be the case. Not necessarily all bad news. So this slide here is indicated to show what happens when the Fed steps in to hike rates, what happens with impact for balance sheet runoff and rates. We see right here, and I hope you guys can see my mouse, but going back into 2016, Fed, green is mortgage interest rates improving, red is mortgage interest rates deteriorating. Fed rate hike 25 basis points. We see a response followed by this red line. Go up, go up, go up, hike 25 basis points, response, response, response. Runoff starts, response, response, response. So here we see correlation for mortgage interest rates, economic response, all of those components yield into mortgage interest rates responding to monetary policy. Another common component that we've been hearing a lot of is around the inversions of the yield curves. And essentially what that means is we look at long-term treasuries versus short-term treasuries. When they cross over, it creates an inverted yield curve. One of the main leading indicators around a possible recession. We look back, this goes through 2021, and here we are, April of 2022. We saw the 10-year yield curve, or the 10-year treasury, cross that of the 2-year treasury. And basically what that means is an individual who invests, or an investor who invests in treasury notes, that 2-year yield was greater than that of the 10-year yield. So why would people put money tied up for 10 years into a longer security when they could do the same investment into a shorter term and experience a greater yield? So inversions lead to recession. So looking back to recessions back into the 80s, that same inversion, inverted yield curve, we look pre-1980 again to previous slides, Burns and Volcker, combating inflation, yield curves cross, what happens? Gray bar represents recession. Inverted yield curve post that, mid-80s, recession. 1990s, recession. Inversion into the 2000s, dot-com bust, recession. Financial crisis, recession. COVID, inverted yield curve leading into 2020. COVID hits, recession. Here we have again, leading indicator into a possible recession's inverted yield curve. What happens next? Unemployment rates, the fail-safe indicator for every recession leading up to today, 100% fail-safe is that of unemployment rates. Once we hit record low employment, it's a surefire component that we will experience a pending recession. So this charts back into pre-1950, and here unemployment rate on the left, year on the bottom, and again the darker bars represent recession. Unemployment hits low, followed by recession. Unemployment tapers up, so on and so forth. We see that through history's past. And again, this leads us to current day. Unemployment rate right now currently sitting around 3.4, which was pre-pandemic levels, could possibly be a leading indicator that we are entering into a possible recession. What happens to mortgage interest rates during recessions? Again, on that opening slide, we saw this goes back to the late 70s. Gray bars again represent recession. Leading into the recession, mortgage rates spike. On the tail end of a recession, mortgage interest rates fall. Mortgage interest rates spike, fall, spike, fall, spike, fall, spike, fall, spike, fall. Here we are again. Again, we're starting to kind of build a very compelling case. 3.75, 2.75 to 3.75, 6 to 4.75 in the financial crisis. Dot-com bust, 7.375 to 6.75. The early 90s, 11 to 8.75. Early 80s, 18 to 13%. And again, late 70s, early 80s, 16 to 11.75.
Hey, Eric, real quick
Yes,
question,
sir.
just to jump in there real quick. So do you think you're going to see rates go down then after this?
So great question, Nate. And that's a common question that we're getting right now. So as we've seen, I mean, this has been probably one of the greatest run up in mortgage interest rates that we've seen in our history. Over a 3-month span, we saw mortgage interest rates rise from effectively 2.5% to 5.5%. So here, if we are a leading indicator that we're entering into a recession, if we use history as the best context, interest rates should fall. And I say should in that if inflation gets under control, which what the Fed is doing is, yes, they're aggressively attacking inflation. The response would be having mortgage interest rates follow behind. So no, great question, Nate. Housing, another key component within housing aspect is we look to home prices through recessionary indicators. And I will make a very key note here is that with the exception of 2008, home prices gained momentum inside a recession. So we go back as early as 1960s, recession, home prices remained relatively flat. Leading into the 70s, we saw a gain, mid 70s gain, 80s gain, 90s gain, early 2000s gain. 2008, I think it's very noteworthy to note here, the recession that caused the financial crisis was on the backs of the housing market. There was a number of, or the integrity and quality of financing was not there. So with that, housing was inflated, recession was brought on due to housing, which in turn drove home prices down. We look back to the most recent recession we experienced through COVID, home prices gained significant momentum. Same is true for what we're expecting to come here in the coming months. Another key attribute here of why, tying this all back to, are we in a bubble, is really centered around supply and demand. We look back into the early 80s around inventory, 3.5 million, average has been 2.5 million available homes for sale at any given time. If we look back into the early 80s, we peaked in 2007, leading into the Great Recession, 3.7 million homes available for sale. Look what's happened in the subsequent years thereafter, bringing us to our current. Nationally, there are 870,000 homes available for sale, 3 million less homes for sale leading into the current context. Another key attribute here too is household formations. So here, going back again, 2007, household formations were 116,000 year over year, and we saw it incrementally increase, bringing us to 2021. Is when the most recent data was released. 129,000 new households formed, but going back, so 14 million more households, but almost 3 million less homes for sale. So again, the question that is pondered here is, are we entering into a bubble? Well, if we use the simple fundamentals of supply and demand, we have a housing shortage and an increasing population, an increasing number of household formations. There are not enough homes available to satisfy current demand. So with that, knowing that we're on the hinge of a recession, we're significantly undersupplied as a market, the storm is brewing that we will continue to see home values and home appreciation weather. Now, what we've seen in the last 2 years, really, 20% year over year appreciation, that is abnormal. That cannot be controlled. So with this recent run up in interest rates, kind of call it the quote unquote cooling off of the market, this is a rebalance to normal seller's market, but the facts are still there that we do not have sufficient inventory to satisfy demand. So even if we see a kind of a suppression of activity of people wanting to purchase homes, in 3 months prior, it was not uncommon to hear 40 plus offers being made on a property. We're now hearing, anywhere between 7 and 12 offers being made on a home. That is a very, very strong seller's market. So here, the fact that we have such a depressed number of homes available for sale and still a growing population and growing demand within the housing growth, the recipe is there that we will still see strong forward appreciation. With that concludes kind of the data. So I wanted to kind of tie it back and again just address the fact that likely we are entering a recession if we're not already in one. And again, a recession is not necessarily a bad thing. Are there, auxiliary fallout from recession? Undoubtedly. But the two main drivers within a recession, if we use history as our best context, mortgage interest rates benefit, housing continues to grow from an appreciation standpoint. So here, if we are entering a recession, if we're not already in one, the likelihood that we will continue to see strong growth in housing is supported with 50 plus years of data behind us. With that, I'll kind of open it up to what questions everyone has from that information we just went through.
If you have any questions, feel free to put them in the chat. I have one real quick right here, Eric. How high do you see mortgage rates going?
That's a great question. And really, my crystal ball is unfortunately broken, like a lot of people's are right now. But looking at the fact that inflation is still a hot topic, and really the main combatant to challenge inflation is through the adjustment of monetary policy. Right now, 30-year fix is currently sitting around 5.5%. It is not unlikely to see mortgage interest rates, touch or possibly break 6%, but really going much higher than that, it's economically not feasible, as that really has impact to debts that are owed specifically in the corporate structure, personal debt cycle. So I believe we'll see rates possibly touch or break 6% and then start to fall from there. Great question though. Thank you.
Yeah, kind of a follow-up on that one. Do you still think demand for homes will keep increasing even though those rates are going to still be increasing?
That's another great question. So here, you look at, going back to this slide here, number of households created. The fundamental component to that question is people still need housing. So this is sale specific. We also are experiencing the same phenomenon in the rental space. Demand for housing is increasing due to the number of households being created. Rental market is going just as bananas as that of the real estate market. So affordability has not yet been challenged, and I don't see it being challenged just due to how wages have grown in the sector that is specific to being able to qualify for housing. So where I don't believe we'll see affordability challenge, assuming we keep interest rates into that kind of 6% threshold. But the rudimental component to that question, Nate, is that people still need a place to live. So here, the fact that our population is growing, households are growing, supply is at an all-time low, I still believe we will still continue to see a strong demand for housing.
Definitely.
Great question. What else?
Sure. We got one here. Are all the numbers you're speaking of, are they national numbers? And if so, can you comment on our San Diego market?
Great question. Yes. So these slides are specific nationally. Now we have to always take a step back and look at it more from a macro instance. San Diego specifically, I see these numbers being even more compelling to demand that housing will continue to see a strong run up. And there's a couple factors specific to that. Housing here in San Diego County, we have a finite amount of land available. So here, the building activity in San Diego County is, there's not many more places that we could build, especially in the coastal communities. We're not building any new coastline. So here it's reliant solely on resale properties. Another key attribute to that is San Diego specifically has one of the strongest jobs economy in the nation. We rank amongst the top 10. So here, and we've got representations and diversification within the jobs market from military, biotech, technology. I mean, you look to, Google, Amazon, Apple. There's rumors that Apple is opening up a new campus in the Sorrento Valley area. Those huge tech conglomerates are relocating their people here to San Diego County. So demand incredibly strong. The buyer appetite, so wage growth here because of the diversification within our jobs market, is incredibly strong. I believe San Diego will continue to feel and experience strong appreciation numbers going forward. Great question.
Cool. Kind of tying into what you had mentioned before, is there any data supporting an increase in supply over the next year? Are more new construction developments being completed?
So that's another great question. So we are seeing a kick up in national builders, and here specifically in San Diego County. But the component of being able to build land, we have a finite amount of land here in the county. So builders are snatching up land to build, but the facts are we're still, as of today, at a 13-year low of new units of construction that are available. And you couple in the supply chain chaos, it's a challenge for builders to ramp up their demand. You look at the cycle of when ground is broken to key delivery with the permitting process, building, land acquisition, goods, supplies, you name it. It's realistically about 24 months from the date they break ground to key delivery.
Nice. Follow-up question here. Is it possible that the coming recession could increase supply as workers potentially lose their jobs and are unable to keep up with their mortgage?
That's a great question. And there's a couple pieces of that we need to unpack. So number one, the amount of equity that the average American homeowner holds is at an all-time high. So here we look at approximately $7.2 trillion nationally is locked up in equity in people's homes. So here, looking back to the financial crisis where that number was significantly less, people were over leveraged. The type of financing that was available, you could purchase 100% financing and basically not make mortgage payments towards principal. So your equity deteriorated. Here, the average American is sitting on a wealth of equity. So here, if we do see unemployment spike nationally, where people are unable to make their mortgage payment, they have significant equity built into their homes. So the trade-off, as opposed to having the bank take the home, go to open market and sell. Now, looking at unemployment, with the exception of COVID, where we saw unemployment just hit an all-time high, I don't see, and not just myself, there's a number of very formidable individuals within the economic and financing sector that, given the kind of wage increases, don't expect to see a wave of foreclosures that challenge kind of the availability of housing and affordability of housing.
Nice, excellent, yeah.
Great question though.
I think that's all of them that I had coming in. If anybody else had any other questions, feel free to jot them in the chat.
Perfect. And more than welcome to come off mute too, if it's easier. Got a couple more minutes that we procured time wise. Want to be respectful of everyone's time. But again, well, we appreciate everyone taking the time out of their day to be here. As we mentioned on the start of it. Oh wait, one more.
There we go. Yeah. So where do you think prices will go this time next year in San Diego?
Oh, that's a great question. And again, my crystal ball is broken, but looking at what we've seen year to date, we've seen a sustained month over month price increase. Appreciation numbers 2.5% month over month, and recent expectation reporting show that we'll see another 10 to 12% appreciation here in San Diego County alone. Fast forward into 2022, given the fact that we have such a supply shortage and still an incredibly high demand, I continue to see and expect home appreciation in that 9 to 12% number.
That's awesome.
Yeah. No, but all great questions. And again, we appreciate everyone taking time out of their day to be here. As I mentioned, we did record this session. This is the first of a number of series that we'll be partnering with J&J Realty to go through. Really, we want to be a steward within the financial real estate community to ensure that you have as much useful information to make the most informed decision around purchasing and transacting in real estate, and really be a wealth partner through this. So any questions, Nate and myself are here. J&J are a part of it too. So any questions, we would love the opportunity to talk through it and help you navigate this wild and crazy market. But again, thank you all for being here today, and hope you guys have a wonderful Memorial Day weekend.
Thank you so much, Eric.
No, thank you, Nate.